Joining me now is Tom Vosa. He is Director and Head of Market Economics at the National Bank of Australia. So what are your expectations from the minutes of this meeting?
Well, it's an inflation report set of minutes. Now, generally, when the committee try and do things differently, it's around this quarterly outturn. We think our core view is 8-1, with sentence continuing to vote for higher rates. But remember, in that August inflation report, the committee as a whole revised down their forecasts for growth and basically told you that if rates were on hold at 0.5% for the next 2 years, inflation would be well below 2% in 2 years' time. If they believe that projection, then you have to start thinking that they're looking at monetary easing. They're looking at doing a little bit more, perhaps a bit more QE, spend it into the economy, especially as their core forecasts are well above those of consensus. They're even above those of the Office for Budget Responsibility.
Right, so what does all this mean for interest rates ultimately, and indeed Andrew Sentence's position?
Well, I think he'll continue to be the outrider, but remember, if we look across at the Fed, Hernig's been doing that essentially for the past 7 months and still hasn't really been rejected in terms of higher rates. I think Sentence clearly is worried about inflation expectations. Will this burst of food price inflation feed through? Will we start to see wage demands going up? He'll continue to vote for tighter policy. But I think the rest of the committee will wait and see. The signals within the minutes will be how many of them are looking at doing QE, even if there was no formal vote just yet. But if the global economy continues to slow down a little bit, if inflation continues to cool, then I think we could start to see QE being revisited at the beginning of next year.
So how do you assess the possibilities of a further round of stimulus? So is it almost, well, I mean, you're predicting next year, right?
Early next year. Remember, after we've got through the VAT increase and we'll start to see where underlying inflation is. CPI is above target. When you look at CPI-Y, the bit that gets rid of indirect taxation, underlying inflation without VAT increases in the UK is running about 1.4%. It's very low. It is below target. The inflation that we're seeing is due to fiscal policy, increases in taxation. The underlying economy is still a lot weaker.
But the core inflation figures, which exclude the kind of more volatile elements like energy prices, are expected to have come down, which would boost the argument of Governor Mervyn King.
And indeed they did. I mean, although of course you can argue core inflation excludes everything that's going up, food and energy. If you remove those things, then of course it's underlying. But the big thing is the difference between the indirect taxation measure, CPI-Y, and headline CPI. Headline is 3.1. Get rid of tax, get rid of the VAT hike, we're running about 1.3. That, for us, is probably a better equivalent of the underlying rate, and that's still very weak.
Explain to me the significance of inflation expectations in terms of what you said about wage demand, something we've already seen. Many analysts anticipating further industrial action, the threat of further strikes in the country in the next few months as austerity measures take hold.
Modern central banking is all about how do you manage inflation expectations. The typical cycle that they get into in terms of boom and bust, and we're trying to remove that from our vocabulary, remember, is the economy runs a little bit too hot. We start seeing wage pressures build up. After that, you then get the wage inflation spiral. Now, at the moment, because of the slackness of demand, the fact we have huge amounts of spare capacity in the UK, we haven't seen huge amounts of wage pressure. But with food prices going up, and remember, most people will shop at least once a week for food, will that start to make people believe that the rate of inflation in the economy is higher than it actually is? Will they then demand higher wages, and do we get involved in that wage price spiral? If we do, then they'll have to tighten policy almost irrespective of the economic conditions.
Tom Vosa, Head of Market Economics, National Bank of Australia, thank you so much. I appreciate your time.